How's it going, everyone? This is Mike with InvestTheory.com. Welcome to episode 4 of our option spread series, where we're going to be taking an in-depth look at the bull put spread. Now, before we dive into any specific examples of how to use the bull put spread, let's quickly refresh on what this vertical spread is and why we would use it. So, as we learned in episode 1, the bull put spread is a bullish to neutral position. In order to set it up, the trader needs to buy a put option with a lower strike price and at the same time selling another put option with a higher strike price. Again, both of these puts will need to have the same expiration date. Now, the reason we would want to open a bull put spread is because we believe the underlying asset or stock is going to have a strong increase in price or remain neutral and trade sideways. So using this strategy allows us to capture the profit from any upwards momentum or time decay if the options should expire worthless. And here's a diagram that basically shows how the bull put spread enters into our profitable and non-profitable zones. So remember, since there's defined risk, there's also defined profit. So we get a chance to see our max profit and our max loss on this diagram. So let's take a look at an example. Let's say we've got stock XYZ currently trading at $40 a share. Now, we believe that the price of XYZ is going to increase soon, but it could be sideways trading for a little bit before doing that. So we could purchase the long call, or we could open a bull put spread and define our risk a little bit. So what we do is we buy one contract with a $38 strike price for $1.10 each. We then sell one contract with a $44 strike price for $2.80 each. Our net cost on this trade is the buy minus the sell, and since our buy is lower than our sell, well, we're going to walk away with a net credit. In this example, our net credit is $1.70. Now, remember, our goal is to capture the increase in momentum or sideways trading in the asset while risking less upfront cash. Now, if the price of XYZ closes at $42 or higher, we've reached our max profit area. Our max profit is the credit that we received up front. In this case, it's going to be $1.70 or $170 per contract. If the price of XYZ decreases beyond our long put of $38, we will have entered into our max loss territory. Now, we can calculate this by taking the strike price of the short put, which is the higher strike price, and then subtracting the strike price of the long put and the net premium received. So our short put was $42, and we subtract our $38 long put strike price as well as the net credit of $1.70 that we received up front, and we have our max loss of $2.30 or $230 per contract. In this example, we are risking $230 in hopes of making up to the max profit of $170. Now, it's also important that we determine our break-even price as well. For this particular trade, our break-even is going to be equal to our strike price of the sell option minus the net credit. So our break-even for this is $40.30. Here's what all of this looks like on our bull put spread diagram. Now let's take a look at a real-life example. Here is Verizon with October 26, 2018 call and strike prices. Verizon is currently trading at $53.39. We decide to sell the $54 strike price for $1.69. At the same time, we buy the $52 strike price for 68 cents. Now, our net credit for this trade is the sell of $1.69 minus the buy of 68 cents. So our net credit is going to be $1.01. Our max loss for this trade is the sell strike of 54 minus the buy strike of 52 minus our net credit of $1.01. So our max loss is going to be 99 cents. In this example, we're risking $99 to make up to $101. Our break even for this trade is to sell the strike price of $54 minus the net credit received of $1.01. Our break even is $52.99. Here's what this example looks like on our diagram. Now, to quickly recap, our net credit is the sell minus the buy. Our max profit is the net credit we receive. Our max loss is the sell strike minus the buy strike minus the net credit received. And our break even is the sell strike minus the net credit. Now remember, the bull put spread is a good strategy when we believe that the price of the stock will see a great increase or potentially remain neutral to allow us to capture the premium. While the profit is limited, we also define our risk as well. Tune in to episode 5 where we're going to give an in-depth guide on how to trade the last strategy in the vertical spreads, the bear put spread. If you're looking for a knowledgeable and fun community of traders to hang out and share ideas with, look no further. Invest Theory has brought over 3,000 traders just like you together in one free Discord chat. Join by clicking the link in the summary today and see how we can help you become an even better trader. This is Mike with InvestTheory.com, signing out.